Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. This is Tuesday, the 10th of January. I'm Daniel Lam, your host for the podcast. The top FAQ that I've been getting is it too high to be chasing Hong Kong and China equities? China is expected to be the only major economy to report stronger economic growth in 2023 versus 2022. Now, SCB Financial Markets Research is projecting an above consensus 5.8% GDP growth for the year of 2023. The key driver, of course, is the earlier than expected COVID relaxation. Now, let's look at a couple of areas of concern from investors. The first one is how a sharper than expected infection rate is likely to hurt economic growth in the near term. Local governments estimated that some 60% to 85% of the population has gotten COVID since December. Despite policy relaxation, 2023 New Year long weekend has seen a mere 40 bips rise in the number of tourist travels and a 4% rise of tourism income from 2022 levels, and reaching only 43% and 35% of their 2019 levels, respectively. As such, we see China's GDP growth recovery only becoming more material and sustainable from the second quarter onwards, and more monetary policy easing will be needed in the near term. However, do note that consumption is still going to be the bright spot this year for GDP growth and may contribute 4 to 4.5% to annual GDP growth on pent-up demand and elevated savings. The second area of concern from investors is how much of this is already in the price. Well, the speed of rise in the Hang Seng Index is likely to slow as it is no longer a low-hanging fruit, so to speak. And the discount of valuation of Chinese equities versus Asian equities has also been narrowing, despite the fact that it is still below the long-term average. But if you look at the volume of buying, it has been very strong. The volume since the end of October is still more than twice of what we saw in the first 9 months of 2022. So there is still likely to be some upside left in the Hang Seng Index from the current level. Major resistance for the index lies ahead at 22,200, where investors are likely to lock in some partial profit. Now, investors should consider adding around support levels, which is at 19,300, followed by 18,400, with a focus on consumption sectors where we're overweight, i.e. communication services and consumer discretionary. That is all from me for today. As always, if you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.